Well, hello and welcome to another episode of the Lending Podcast. We are your hosts here in Austin, Texas. That's Jeff Jones, and I'm John Burnham. Thank you for being with us again today. We're going to talk about refinancing, how to know when to refinance and why you might want to refinance.
Yes. And as we were getting ready for this episode, we were talking about, what this means for people out there that own homes or looking to buy a home. And what that means is how do you know the best time and how to spend, I think you said it perfect, how to spend the least amount of cash to save the most amount of cash.
Absolutely. And there's more than one way to do it.
There's more than one way.
Yeah. So let's dive in. I think the best way really to start is to tell you about some recent conversations we've had. And now here we are. Rates are at the absolute lowest they've been in a year. It's really a fantastic time for the mortgage industry's headlines because we have wanted and needed rates to come down for a while now. And so here they are. We're making that progress. We have a slow decline. It's actually compounded over the last month or two. And ironically, we're seeing some rates in the even high fives, low sixes. Depends what scenario you have out there. The averages say 6.6.
Right.
But again, averages are across the board, all loan types, all credit scores. And so specific to your scenario, you might be a little lower, you might be a little higher.
Right.
But some of the recent conversations we've had. So I'm working with a lady right now who is a single borrower. She lost her husband a couple years ago, 1 or 2 years ago, and has done a lot of home improvements to the home. But in so doing, she's racked up some unsecured credit card debt at a really, really high number. So the interest rate on her mortgage, and this is a dilemma we have for a lot of folks out there, interest rate on the mortgage is like 3.25%.
Yeah.
But she's paying 27.99 on these credit cards, and it's six figures, over six figures in credit card debt. And so we're going to consolidate those, save a huge amount on a monthly basis. It's over $1,000 a month in savings. Yes, she's going to lose that 3.25 on the first mortgage, but she's wiping out that credit card debt. And that's just one scenario. There's a million, but yeah, so that's one.
Yeah, I mean, look, we all know the struggle is real right now. This recession is kicking people hard, and it's tough. So when you are living your life and you haven't cut expenses as far as maybe you thought you should have, or you just don't have a way to cut expenses yet, and you hope to, there's a lot of people that have to put things on credit cards that they normally wouldn't. And I get it. I think a lot of us get it because it's expensive out there. Everything has gone up in cost and maybe your income has gone down. And so when that happens, you have this way of living that you're used to and I don't want to have to move or downsize my whatever it might be that you're downsizing or get rid of the car I just, got. So we all are kind of having this huge gulp of what do I do with more expenses and how do I pay for it? And so the credit cards have gone through the roof for a lot of people. And so if you find yourself in that situation, it might be a great time to look at refinancing because you can consolidate some debts as you take out a bigger loan, extend your loan a little bit, maybe even skip a month because it's now going to have a new first payment date.
That's right.
So you get a relief of a month. And when people don't realize when you're doing a cash out, is how much money do you have to come to the closing cost table for a cash out?
Oh, zero.
Zero or close to it. There might be some incremental daily rate averages, maybe under $500, right?
Sure.
And so you get to do that, skip a month, extend your thing, pay off a bunch of debt. It puts you in a great situation possible.
That's right.
So,
yeah, and you touched on wages may not have increased over the last couple of years,
right,
like the cost of goods, and that's statistically correct. I mean, think about just car insurance or home insurance, renter's insurance, anything insurance related has certainly gone up.
right.
Of course, our grocery bills are more, our gas bills are more, right?
Eating out has gone through the roof.
Eating out's unbelievable.
Yeah.
I mean, it is so expensive, and of course, you're eating out, you're getting good service, you're also leaving that tip for the server,
Yeah.
and so you compound this dinner out where it may have been used to be $30 or $40, it's $60 or $70, or more.
Well, we just we took our first vacation in 2 years. We just got back 3 days ago from Florida. It was great, Daytona Beach, shout out. And we did like a little excursion for 3 days, same one we did 3 years ago. It cost twice as much. Do the
Yeah.
exact same thing we
Yeah.
did 3 years, twice as
Yeah.
much.
Yeah.
I mean, that's
Well,
crazy.
we went to dinner last night. Six of us, three couples in the neighborhood, and dinner, and we had some beverages as well. And with tip and everything, it was $330.
Mm-hmm.
So it is $50 a person if you're out to dinner.
Minimum.
And this was a restaurant in the neighborhood. This wasn't to
Right.
make a reservation somewhere super fancy
Yeah.
for a once a year type event. This was dinner in the neighborhood.
Yeah.
So it has gotten expensive. So we say all that to say that wages have not really kept up with the
Right.
costs increasing. We understand that there's a compound effect of debt out there in the United States. Credit card debt's at an all-time high.
Yeah.
So how do we restructure the debt if it makes sense? May not make sense. We'll crunch all the numbers for you, but let's look at what amount of equity do you have in Texas. We're obviously here in Austin, Texas. Anywhere in Texas, you can borrow up to 80% of your home's fair market value. That's not the county, what the county thinks it's worth. That's what an appraiser, a third party appraiser, is going to appraise it at. So if you have a house worth 500,000, you can borrow 400,000, right? 80%
Right.
of 500. Now, if you owe 250, the delta between 400 and 250, that's the amount of equity that you can tap into. You can get to $150,000 of equity. And there are multiple ways to tap into that equity, whether it's a second lien, like a home equity line of credit, or whether you redo the whole first mortgage.
Mm-hmm.
Now, I want to touch on something because this particular client that I'm working with, this lady, and she was referred to me by a CPA here in town. She has already taken out equity in her home previously.
Okay.
And if our listeners take nothing else from this episode, I really, really want to hammer this point home. And someday, somehow, maybe there'll be enough of us influencers in the mortgage industry to change this law in Texas.
Texas A6.
I believe this is a huge disservice to our homeowners here in Texas. I understand the spirit of the rule that I'm about to tell you about, but it's not practical when we were at the reduced interest rates that we were at for so long, and our clients were cashing out at 2 and 3% mortgages. Now your equity has grown. Perhaps your home's doubled in value if you bought your house 10 years ago. It's an amazing increase in equity. If you've previously taken out equity in your home in Texas,
cash out refi.
you cannot get a home equity line. You cannot get a second mortgage that's also a cash out behind a first mortgage that was previously a cash out.
And that's a Texas specific.
That's a Texas
scenario.
specific scenario.
Yeah.
So we call those Texas A6 cash outs, where 3 or 4 or 5 years ago you might have redone your loan, you netted some cash. If you got $1 back last time you refinanced, it was considered a Texas cash out. So you can refinance, you can cash out. However, you must refinance the entire mortgage, pay off the current note that might be at a lower interest rate to net the cash that you want. And so we do have some homeowners out there trapped to some degree in that equity position.
They can't get a line of credit.
Can't get a line of credit.
Right.
And if you're in the legislative branch out there, I would throw out this needs to be at least discussed and changed. You know, maybe there's caps on it. Maybe instead of going to 80%, you can go to 70% of your equity, of your value. But there's got to be a way for our homeowners out there to tap into equity without having to redo the first loan. Now, it might be the best decision to redo the first loan. And in this, my client situation, she owes $300,000 on the first, actually about $375,000, and her credit card debt's $140,000. So we're going to refinance $525,000. Well, almost half of her total debt, a third of it, is 28%. And then you've got 2/3 of her debt that's at 3%. Well, if you do a weighted average, it's going to be way more than what she's going to be able to refinance. She's going to be able to save a lot of money, even though she's losing a 3% rate. So I think that's something really, really important. If you're listening to this, you previously did a cash out, you want to try to tap into that equity, make sure you are talking to a mortgage professional who asks all those questions about your previous loan and your current loan. Otherwise, you could get 3/4 of the way through your refinance transaction and find out, whoops, my last loan was a cash out. I can't do the type of loan that I want to do
Right.
because of those laws. And that's a Texas constitutional law. And again, I totally appreciate the spirit of the law. We're trying to limit how much our homeowners can tap into their equity so that we don't get overextended and we don't borrow more than the home's worth. And I understand all that.
The heart of it was
But
for buyer protection.
yeah,
And the problem is going to be like what you're talking about when you're keeping your lower rate and adding a second lien. You create a blended rate that's way lower than if you had to do a full
that's right.
refinance.
That's right.
And so the problem is if you're not allowed to do that because you can't get that second lien, then you're forced to go to a higher rate, which hurts the buyer. So the irony of this protection is it's actually in our current scenario hurting the buyer.
Yes. Yes.
And that is because basically when you go from a 2.75 to a 6.75 or whatever the scenario might be, that's such a huge stretch. That wasn't probably in their minds when they wrote that law.
Right.
But now that is the reality. And so I believe, like you do, it's an archaic thinking, and then it'd be great to get that fixed.
Yes, yeah. I think that there could be some laws written that allow our homeowners to tap into that, change that rule a little bit. So that's cash out refinances, debt consolidation. Perhaps you're looking at cashing out. You may want to buy another property. Like, how much equity do I have to tap in to go use that as a down payment to buy a second home or to buy a VRBO or to buy just a straight up rental property that you're going to put a long-term tenant in. All those scenarios to help build and compound your real estate wealth. Those are conversations we love to have. And that's conversations we're having right now with a lot of clients. One of my clients has 7 investment properties. He has a lot of equity in each one of them. We're doing a small cash out refinance on one of them just so he can have some cash reserves. Right. He said, John, I've got a lot of equity, and he's in the nature of his work right now, sort of between jobs. He's been in the film industry for 30 years and just really would love to have some cash. And yes, you can get a loan even if you don't have a job. That's maybe another episode, but there's ways to do cash outs. There are tools out there. This one's called a debt service coverage ratio loan, DSCR. So we're not going to go into that in detail.
That's great. So episode 8 of the Lending Podcast, Investment Property Loans. We go into that one. It's a wonderful product. And so episode 8, you want to hear more about that?
Yeah. So thanks for bringing that up. And so that's one scenario. And so there's all these different reasons. We're talking to folks that may be going through a divorce. As tough as that is, how do we structure? Maybe it's one spouse is keeping the home, so we need to refinance the other spouse off. Maybe they're at a higher interest rate because they never refinanced and need to refinance to a lower rate, save some money so that the one spouse can keep the house and then maybe go buy something else, or cash out so they can go buy something else and split the equity. So there's just a million scenarios. What are some other?
Well, so and it's not fun to talk about divorce scenarios, but one thing that we've experienced is if the earlier you can talk to your lender, while you're trying to get that decree developed with your attorneys, if you get some loan specialist that says, here's some great options for you. It doesn't have to be it doesn't have to be a sell. It could also be a refi. It could also be this or that. So to have those scenarios available for the two parties so that the decree can be written correctly. We're not attorneys. We're not going to give legal advice, but we can give the right scenarios for the mortgage and how to get the names out of it that need to get out.
You bet. There's always a way. Understanding what your goals are is utmost importance for us, so we can help structure that. And I always say you can't unring the bell, right? Like if you get too far, you do something that you think you're doing something that benefits you without really consulting the professionals and sort of
that has to execute the plan.
Yeah, that has to execute the plan. Then you might put yourself in a tough spot.
Right.
So
we like talking. Us personally like talking directly to the attorneys for your behalf.
Absolutely, we're happy to. Yeah, we do a 3-way call or something. Right. You bet. And so I think the most common refinance strategy, or maybe one of the more common ones that folks think about, is just lowering the interest rates.
Yes.
Right. Like I just want to refinance, lower my rate. How do I know when to do that? When is the right time? What is it going to cost? And we certainly get that question, like how much is it going to cost? Well, believe it or not, there's refinance options out there where it may cost you zero, like truly $0, right? And we'll show you in full transparency how that's done, because there's always costs associated. There's appraisal, there's title, there's insurance, there are various costs throughout the process, but there are ways to have those costs covered by the lender.
Right.
And we do that through the interest rate, and we'll show you those options. And one of the different comparison sheets that we use is kind of an ABC scenario.
Right.
And there's the lowest rate option, which usually costs the most. It does save the most money monthly, but it may be a longer break even. Then you kind of have a middle of the road option. Then you have like a lower or no cost option.
Mm-hmm.
And so when you as a homeowner can visualize the savings, you can see what it's going to cost you. How are you going to pay for it? Are we going to pay for it by rolling it into the loan, which in some cases is possible? Are we going to pay for it in cash? Are we going to roll in a little bit, bring a little bit to closing? How many months of payments do you skip? You touched about that. You can skip up to 2 payments sometimes. Usually you're skipping 1 payment, but you might be
There's
able
a
to
way
skip
to
two.
time it, and you want
Yeah,
to know what that way is if that's what you're looking for.
that's right.
Yeah.
And so, going from an 8% rate to a 6% rate, it's probably going to be no-brainer math. I think that's going to make sense 95 out of 100 times probably to go ahead and refinance, depending on the loan size and how much you're saving and what it costs. But going from maybe 6.9 to 6.2, that may or may not make sense. Like there's a compression there
Right.
of cost. And I think we've talked about this before, but loan amount really plays in.
Yes.
Because the larger the loan, the more the monthly savings, right? That's kind of an obvious. If you're financing 800,000 versus 200,000, your payment's higher on 800,000 than it is on 200,000. The savings is going to be more on a monthly basis.
Right.
Well, so many of the closing costs are fixed costs.
Yeah.
It's the same dollar amount whether the loan's 200 or 800, and so your loan amount really matters as well. And so we'll walk you through how the math works for your scenario, and then let you be in charge really of making that decision. We'll make it together, but you'll have the numbers in front of you to say, hey, this looks like it makes a lot of sense, or maybe it doesn't. For me personally, I'd like to see a break even between 12 and 24 months. That's kind of my
That's a
personal.
great break even,
Yeah.
by the way.
Yeah. So if you
Yeah.
break even on their refinance within 2 years, now again, if you're going to be in the house for 15 years, then maybe you can do a loan that the break even analysis is
5 or
is
6.
5 or 6, right?
Yeah.
And we're talking about break even analysis. You're really good at explaining that. I think we've done this before, but how do you calculate that? How do you,
Yes.
yeah.
So in different kinds of financial terms, people will call it like a return on investment, an ROI. The break even is a common phrase we use in our industry, is what your break even. The amount of money you spend, right, to get that loan compared to the amount of money you save every month.
Exactly.
Right? So that's the basic math, is cost and time. And so if it costs $20,000 and you're saving $200 a month,
100 months.
it's a 100-month break even.
Yeah, 8 years.
That's terrible.
Yeah.
We would not advise that. That's costing way too much money
Mm-hmm.
for too much time. If the cost is $10,000 and the break even is, $1,000,
You're saving $1,000. That's 10 months.
that's
Yeah.
10 months.
Yeah.
Right? So that's like phenomenal. Anybody in the right mind would do that.
Yeah.
So it's basically your return on investment. When does it break even? Because what's interesting is people are stuck on that number. Time flies in our lives. I feel like the days are long and the years are short.
Mm-hmm.
A break even, you got to understand, after that break even point, you are saving a lot of money.
That's true.
And the other piece to that puzzle that people don't think through very long term is you're building equity faster in your home after that break even too. Not only are you building equity faster, possibly up to that break even, but that's compounded after the break even, because if you want to, you can even make extra payments, right? Because it gives you a how do I put it?
More cash flow to
Yeah,
put towards
more
the
money in your coffer
yeah.
to be able to put towards your monthly. I mean,
Hmm.
I personally pay slightly over my monthly payment just
Yeah.
to shorten my loan, build my equity faster. That can be easily seen. So what you're talking about, those ABC scenarios, side by side scenarios, you'll be giving a transparent look at costs and savings,
Yes.
and you're comparing apples to apples within one company. We talk in our previous episode, Shopping Your Lender, episode 29, if you want to look at that. Um, there's one thing that I want to say because I like to demystify some of the things we hear when we talk to people that are looking to refi. One of them is I'm shopping for the best rate to refi. Every lender out there, 99% of the lenders out there, I should say, because maybe there are lenders that are just one hit wonders. We all have the same rates available for you. Everyone has the same rates available for you. The cost for you may change slightly for that rate based on the scenario and guidelines for each program that that borrower has. That's why the cost is different. So if you're getting quotes, right,
Right.
and you're like, oh my gosh, this guy gave me a 5.99, this one gave me a 6.5. Well, did you ask that 6.5 for a 599 quote? Because they have that available for you.
Yes.
So please know that every rate is available for you from most lenders out there. That's on their pricing sheet. Those range all the way down to 4.125 right now, up to
Yeah.
like 8 point something, 8.5. That's probably about the range most people are seeing today as of August of 2024. As rates continue to come down, we might even be able to get lower. No one's paying for those fours. It's the return on investment's too long. So that's a misnomer. Another misnomer is you don't have to refi with the same person you got the mortgage through.
That's right.
I've heard some strange thing that surprised me when I heard that. I've heard that a couple times now. Oh, I thought I had a refi with my current lender. No, you can refi with any lender. So I'm sure you've heard some
Oh yeah,
weird
that's a really good point. Yeah,
ones.
and who services your loan, who's taking
Right.
your payments
Right.
is not necessarily the best option to refinance with.
Hmm.
Now, if we're servicing your loan, Benchmark, our company, does service loans.
Right.
Obviously, if we're servicing your loan, we have a little more privy to information on your current loan, and
Yeah.
we did your loan initially. Might be a little more seamless to refinance through your existing servicer. But if ABC Mortgage is servicing your loan, doesn't necessarily mean you should refinance through ABC Mortgage.
Right.
And so you can choose who you want to use for
Right.
sure. And I think you touched on a really good point of having more transparency with the various options. And that's really why we do the 3 loan comparison. It probably could be a sheet with 10 options on there,
Yeah.
but we just don't want to make your head spin around. But we can look at 10 options, right? But we usually pick the best 3, and there's value in the rate sheet, the rate stack, as we call it, 5.99 or 6.25 or whatever it is. And so we're looking for the value, the least amount of cost for the most savings. And we're consumers too, right? So we're thinking about it as if this is my personal home, what would I do? And
Hmm.
and then sharing those options with you. And so I think as we enter in to I'm going to call it a mini refi boom. I'm just going to call it right now. Because if you're over
Whoa.
7%, you should be at least having a conversation with your loan officer about your possibilities of refinancing. We're
Can,
seeing rates that are in the realm of discussion for refinances for
yeah.
sure.
Sorry, I cut you off.
Yeah, you're good.
I know that we're kind of bringing this to full circle about what we've talked about. Can you briefly talk about what recasting is? Because there's an option that a lot of people don't know about out
Yeah.
there called recasting.
Yeah, refinancing versus recasting. I think recasting is a great option. So the scenarios where we see recasting work the best typically is, let's say we have a homeowner who's bought a new primary home and they still had a house when they bought. They bought before they sold.
Yeah.
And so then they've sold their previous home now, and they got an influx of cash, 100,000, 200,000, whatever, a
Hmm.
big chunk. A lot of our clients take that chunk and they want to put it towards the mortgage that they got initially to reduce the payment. It does not change the interest rate, right? It's just recasting the payment based on the lower principal balance.
Right.
So if you bought a house at a 500,000 loan, you've now got 200,000 in cash, or any amount. Really, 10,000 is about the minimum you have to do to recast. You don't have to have 6 figures. But if you have a big chunk, you can take that amount, put it towards that loan that you have now, the 500 loan. Now you have a $300,000 loan, right? and the lender's going to recast the payment and re-amortize the payment based on that 300,000 versus just making a principal payment on your 500K mortgage. You still owe 300,000 now, but the payment is based on the 500,000 original loan. The payment doesn't change unless you do the recast.
I love it. So that comes full circle to the concept of how do you spend the least amount of money to save the most amount of money?
Yes.
You know, so this is the when conversation and the
Yes.
how much conversation. And you want a lender you can trust and gives you transparency and gives you good information to make good decisions. But now may be a right time if you're a listener out there, and you're wondering if this is a great time, please contact your loan specialist, your favorite one. If you're in Texas, we might be your favorite one. We're here for you. So that's great. What else do we want to mention right now?
Well, I think there's so much opportunity right now to plan ahead, to be thinking about
Mhm.
the future, the next 6 to 12 months, especially our clients who may have had a job change. You may have started a business. You may have changed the way that you pay yourself because you have a business and you were 1099, now you're W-2. We're seeing a lot of unique income
Right.
situations, and so I just urge you to get some clarity on how your personal changes, your employment changes, maybe your credit changes, or your life changes, how that impacts your financeability, right? And your ability to get a mortgage in the future, and have those conversations about what does next year look like? What are
Yeah.
some of your goals out there that we can help you achieve? Um, and it's just never too early to start planning.
Yeah, and I want people to know that, if you only own one home, which most people that own a home, it might be their only one they own at the time, it doesn't have to be a kind of set it and forget it mentality where like
Mm,
I have the mortgage and it is what it is. I'm good with the monthly payment. It does not hurt. It does not cost you anything to talk to a loan specialist if that piece of equity, your home, can do more for you with a new scenario than it's doing right now. And it's
yes.
just that simple. You own something phenomenal if you're a homeowner that is bringing you a unearned wealth, so to speak, right? Because now it's an asset that's growing in value. How do you use it to better the scenario you got 1, 2, 3, 5 years ago of your loan when you got your loan might not be the best scenario for you still. And that's as simple as it is. Like
So true.
reevaluate your loan to see if it can work for you better.
Yes. And I'll add to that, that's well said, because there are other components to your payment, not just the interest rate.
Right.
The home insurance, the property taxes, the PMI if you're paying PMI. So refinancing maybe out of an FHA loan that has PMI into a conventional loan that
Right.
has PMI, refinancing a conventional loan that had PMI initially, but now you have enough equity to not need to have PMI and you can lower the rate. There's
Right.
some compound effects of refinancing, especially recalculating your property tax rate. I see this a lot of times. I mean, the
Mm-hmm.
property taxes are what they are, what you're paying the county, right? But your mortgage company has to constantly balance that escrow account by maybe increasing your payment slightly to cover a shortage,
Right.
decreasing your payment slightly to handle that surplus. And so the taxes, we've seen payments really jump because of property tax shortages from 2022 and 2023. And now it seems taxes seem to be kind of leveling off. We had a huge spike, during COVID of property values. I think the counties really they're getting it right, or at least they're making improvements there. But if your payment's a little out of whack because your home insurance costs doubled and then your payment went up to cover that, let's make that a component of the
Right.
refinance discussion as well
Right.
and sort of recalculate what's the current taxes, what's the new insurance. Maybe we're getting rid of MI. All of a sudden, it's $500 or $600 a month. And what would it mean if you save $500 a month right now? That you can pay your car off
Pretty
faster.
sweet.
You can pay for some childcare. You can
Yeah.
pay for all kinds of things. Pay off some debt. So that's really the purpose. It's really not, well, my interest rate's 4 and the interest rates are 6. I'm good. You probably are good with just your mortgage, but what other components could we
Mm-hmm.
help educate you on and help you on? Or if you say, well, I got a rate at 7 and I talked to a lender and they said I shouldn't refinance until they get to 5.
Yeah.
I mean, there's just a lot of not misinformation. There's just too much information, and
Right.
I think it leads to analysis paralysis, right? And
100%.
so you end up kind of doing nothing because you're like, well, I think I'm good.
Information overload.
Yeah, for sure.
Yeah.
So that would be my final thoughts: is have that conversation. Look at the mortgage. I love what you said. It's your biggest asset. Look at it holistically. Look and see if there are any components of your payment, your HOA, I'm not HOA, excuse me, your PMI being one of those that could be redone with your loan to maybe cut that cost in half or maybe get it eliminated through refinancing. And so all of a sudden, all 3 or 4 components might be able to be improved,
Mm-hmm.
and it's a compound effect on the savings.
Right.
Yeah.
Good.
Yeah.
Love it.
Hey, that was good. I appreciate it. Thanks for tuning in today.
Yes. Thanks for tuning in to the Lending Podcast. We are your hosts, JB and JJ, here in Austin, Texas. Please like, subscribe, share, and give us your comments of what you'd like to hear from us. Thank you so much.
Thanks so much. See you next time.